If you are over 55 and you have not heard about this yet, you need to stop whatever you are doing right now and pay close attention, because what I'm about to share with you could save you tens of thousands of dollars or cost you that same amount if you ignore it. The IRS just quietly updated rules that directly affect millions of Americans who are 55 and older. And I'm not talking about some small technical adjustment buried in a government document. I'm talking about changes that affect your retirement accounts, your home, your Social Security, and the money you plan to leave behind for your family. Most people will not find out about this until it is too late, but you are watching this right now, so you have a chance to get ahead of it. Let me start with the first thing you need to understand. For decades, Americans over 55 had certain protections and advantages built into the tax code. Things like the old home sale exclusion that used to kick in at 55, catch-up contribution rules for retirement accounts, and specific exemptions tied to age. The IRS has been quietly restructuring how these benefits work, tightening some, expanding others, and adding new conditions that most people and even most accountants are not fully aware of yet. This is not something that is going to affect you someday down the road. This is affecting people right now, people who thought they were doing everything right, people who have been responsible, who saved their whole lives, who followed the rules as they understood them, and they are getting hit with bills they never saw coming. I do not want that to happen to you. So, stay with me, because what comes next is the part most videos like this never actually tell you. Here is what changed and why it matters to you directly. The first big shift is around retirement account withdrawals. If you are between 55 and 59 and a half and you recently left a job or took early retirement, there is a rule called the Rule of 55 that allows you to pull money from your 401k without paying the normal 10% early withdrawal penalty. Most people do not know this exists, but here is what changed. The IRS has updated how strictly they are enforcing the conditions around this rule. If you roll your 401k into an IRA before taking those withdrawals, you lose the protection entirely. Thousands of people are making this exact mistake right now and triggering a penalty they did not have to pay. The rule only applies to the 401k from your most recent employer, not an old one, not a rolled over account, the one from the job you just left. If you already made this mistake, there may still be a way to correct it, but you need to move fast because the window is narrow. The second change is around health savings accounts. If you are 55 or older, you are allowed to contribute an extra $1,000 per year into your HSA on top of the regular limit. This is called the catch-up contribution, and it is one of the most powerful tax advantages available to anyone in this age group. Here is the part that changed. The IRS updated its guidance on what qualifies as an eligible expense when you're approaching Medicare age. If you are planning to use your HSA money to cover certain insurance premiums or long-term care costs, the rules around what is allowed and what triggers a tax penalty have shifted. People who have been saving in their HSA for years are now finding that the withdrawals they planned are being flagged, and when the IRS flags an HSA withdrawal as non-qualified, you pay income tax on it plus a 20% penalty. That wipes out years of tax-free savings in one move. The third change is the one that is hitting the most people hardest right now, and it involves your home. There used to be a rule specifically for people over 55 that allowed a one-time exclusion on home sale profits. That rule was replaced years ago with the current system where you can exclude up to $250,000 in gains if you are single, or $500,000 if you are married, as long as you lived in the home for 2 of the last 5 years. Most people think they understand this rule. Most people are wrong about at least one part of it. Here is what the IRS just tightened. If you have rented out any portion of your home, even a single room, even occasionally through a platform like Airbnb, the calculation of your excludable gain changes significantly. The IRS is now cross-referencing 3,599 second K data from rental platforms with home sale records. If they find that you received rental income from your home and you are claiming the full exclusion, you will receive a notice. And that notice comes with taxes owed plus interest, going back to the year the rental income started. If you are planning to sell your home in the next 1 to 3 years and you have ever rented any part of it, you need to talk to a tax professional before you list that property, not after you close, before you list it. Because once the sale is recorded, your options shrink dramatically. The fourth change affects people who are still working at 55 or older and have both a traditional and a Roth retirement account. The IRS updated its ordering rules around conversions and contributions in a way that changes how much of a Roth conversion triggers taxable income in a given year. If you have been doing annual Roth conversions as part of a long-term strategy to reduce your required minimum distributions later, the thresholds that push you into a higher bracket have shifted. And if you did a large conversion in the past year without accounting for the new bracket adjustments, you may owe more than your tax preparer estimated. This is especially dangerous for people who paid their estimated taxes based on last year's numbers without adjusting for the new rules. Now, here is something that not enough people are talking about. The IRS has also updated its enforcement priorities for this age group specifically. There is internal documentation that shows auditors are being directed to pay closer attention to returns filed by people between 55 and 70 who show large retirement account distributions, home sales, and self-employment income in the same year. If you had all three of those things happen in the last 2 years, your return is statistically more likely to be reviewed than it was before. That does not mean you did anything wrong, but it does mean that if your documentation is not clean and your deductions are not properly supported, you are at greater risk of a very stressful and expensive audit process. So what should you actually do right now? First, if you left a job in the last 2 years and you are between 55 and 59 and a half, do not move your 401k anywhere until you have spoken with someone who knows the rule of 55 inside and out. One wrong transfer, and you lose the exemption permanently for that account. Second, if you have an HSA, pull up your records and look at every withdrawal you made in the last 3 years. If any of them were for expenses that you are not 100% certain qualified under the updated IRS guidelines, get those records reviewed now while you can still file an amended return if needed. Third, if you own a home and you have ever rented any portion of it, get a calculation done now on how your gain would be treated if you sold today. You want to know your actual excludable amount before you make any decisions about selling. Fourth, if you have been doing Roth conversions, sit down with your numbers and recalculate where you landed in relation to the new bracket thresholds. If you overpaid estimated taxes, you may have a refund coming. If you underpaid, you want to know before the IRS tells you. And fifth, make sure your beneficiary designations on every retirement account are up to date. The IRS updated its rules around inherited IRAs, and the rules for non-spouse beneficiaries have changed significantly. If your beneficiary designations point to someone who would now be subject to the 10-year distribution rule and they are not aware of that, the tax burden that lands on them after you are gone could be devastating. This is one of the most overlooked updates in the entire tax code right now, and it affects families every single day. Look, the IRS is not going to call you. They are not going to send you a friendly reminder. They are not going to give you a warning before they send a bill. The system is designed to collect. It is your job to know the rules, protect your money, and make sure you are positioned correctly before the deadlines hit. You watch this entire video that already puts you ahead of most people your age. Now take one of the action steps I just gave you and do it this week, not next month, this week, because the people who wait are always the ones who end up paying the most.